the first company I visited, I flew out. I was wearing a coat and tie. I dressed up all nice. And I walk in, and the first 10 to 15 minutes, they're wondering why I'm even there. It's $100 million market cap company, and they can't believe they're like, why are you visiting us? No one has been here in 5 to 10 years.
Uh-huh.
So I thought, okay, well, maybe investors only go to the annual meetings. Maybe that's what it is. Maybe
Mm-hmm.
that's what I'm missing out on. So I went to the annual meeting, happened to be 2 months from then. I went to the annual meeting, and I was one of two other investors. So it clicked pretty immediately that this was the way I was going to provide value to my investors, is going into these undiscovered companies or
Mm-hmm.
overlooked companies and doing the same rigorous due diligence I was doing at private equity. And I just realized barely anyone is doing this. I'd
Yeah.
already seen that smaller companies were inefficient or inefficiently priced.
Mm-hmm.
Um, on the private side, I was shocked to find out that it was even more inefficient on the public side. And some of that's for good reason, but some of that is just because it's simply overlooked, like completely overlooked. And if you do boots on the ground due diligence, you're quickly going to become the person that knows the most about the company.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable, quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Whit Huguley, founder and portfolio manager of River Oaks Capital in New Orleans, who launched his concentrated investment fund in 2019 to hunt for overlooked opportunities in microcap and small-cap companies by traveling across the U.S. to meet management teams and tour facilities that larger institutions typically ignore. Whit, how are you? So nice to see you again.
I'm doing great. Thanks so much for having me on, Bogumil. Really excited about this, and glad a mutual friend, John Rotanti, introduced us, and it's been a pleasure getting to know you.
Well, John is a wonderful person. He's been on the show many times. I actually recorded with him a few weeks ago, and I was really looking forward to this conversation. You and I spoke a month or two ago. You were at an event, at a conference. I'll bring it up in a minute. But you opened my eyes to the part of the investment universe that I'm less familiar with. I was very intrigued. And it rhymes with, I would say, the early days of Buffett's investing in some ways, and we'll talk more about it. But before I ask you about that, there's so much to talk about. I want to ask you about the early days, and I ask all my guests, if you allow me. I'm curious about your childhood upbringing and how you think that time shaped you, your relationship with money, and the career path that you chose.
Yeah, I think it's a super interesting question. And I've been running River Oaks Capital for 5.5 years now, and it's something I've actually been reflecting on is what part is nature versus nurture. And I think it's really interesting to think about. I mean, if you go all the way, or I guess before I say anything, I think, and I'll get to it later on, but when I read Margin of Safety, or sorry,
Hmm.
Intelligent Investor by Ben Graham, I had that inoculation that Warren Buffett talks about, but at the same time, the inoculation was almost like, I can't believe everyone doesn't think like this. Like I've been thinking this way my entire life.
Yeah.
So it's interesting. I've thought back on my upbringing and what part of that played a role in the Intelligent Investor being such a obvious, for lack of a better word, book to me.
Hmm.
And I mean, if I think back on it, my grandparents on my mom's side were born in the UK, and that's River Oaks is named after the street they brought or grew their family up on. And after World War II, they migrated to the US. So it's a very funny dichotomy because that's an extremely risky thing to do. But at the same time, they despised losing money in any way.
Hmm.
And, that Warren Buffett quote, I have it written here, rule number one of investing is never lose money. And rule number two is never forget rule number one.
uh,
So I mean, I definitely grew up around that mentality for sure. But at
hmm.
the same time, the mentality of when the risk is appropriate, go all in as well.
Hmm.
It's a very interesting dichotomy that um, when I was in the entrepreneurial world, I witnessed as well. They're willing to take people who are willing to take risks, but at the same time hate losing money. It's a very interesting thing to think about, and I think I fall into that partially because of my upbringing. But I guess to fast forward a little bit, I got my undergraduate degree at LSU. I'm here in New Orleans. This is where I was born, and this is where I've been running the fund for 5.5 years. Baton Rouge is or sorry, LSU is in Baton Rouge, which is about an hour and a half from here. After I graduated, I worked for a startup company for 5 years, and I just became fascinated in what it took to grow a company from, when I started, there was 3 employees, I think, to 10 employees to 20
Hmm.
employees, and all the qualitative aspects of running a business, the day-to-day nature that goes into running a business that not a lot of people think about. They just think about the income statement, how much money you're making, not all the day-to-day problems that you constantly run into. So after 5 years of working in the entrepreneurial world, I decided to get my MBA at Tulane here in New Orleans. So this would have been over a decade ago. And I remember on my entry interview, I said my goal was to start a startup company that was similar to the one I had worked for, venture capital backed. And one of the first courses I took was an investment analysis course. And I read The Intelligent Investor. I read everything by Warren Buffett, everything by Seth Klarman, Peter
Hmm.
Lynch, all the must read books. And within 2 to 3 months, the trajectory of my career completely changed. I was just totally in love with it. I was going through every investment book like I was reading Harry Potter when I was a little kid. I just could not put it down. And I just got immersed in finance. Got my MBA in finance from Tulane, got my CFA, then moved out to California and worked in private equity for a while. And looking back, that was an incredible opportunity I happened upon. And then in 2019, I decided to move home and launch River Oaks Capital in 2020. So that hopefully brings you up to speed to where I am today. And but it's been a super interesting journey.
I love it, and I have so many thoughts, and I'm gonna pull on a thread or two before I ask you about private equity, which is a nice bridge to the next topic I want to bring up. But grandparents, I obviously I picked up an investment book at some point. I talk about it on the show went up on Wall Street. And that's when I feel I discovered investing. But my investing education started with my grandma going grocery shopping. And she just had this intuition: what is price, what is value? Not buying the cheapest thing, but buying the best quality product at the best price, which is what we're trying to do in the investment world. So when I picked up Lynch's book and then Buffett and everything else that I read and Ben Graham's books, I realized I've been collecting those principles ever since I started walking. I just didn't know that there's a field where I can deploy it, not just to fill up a basket on a Sunday visit to a market, but also to fill up a portfolio with ideas. Speaking of portfolios, I have to ask you this, and you and I talked about it a month or two ago. You spend this time at private equity. Incredible due diligence, a company that was buying stakes of, from what I remember, 30 to 49%. And you decided to apply what you've learned in that process to buy smaller positions in macro caps and do your due diligence, tiny companies, but a universe that a lot of investors completely ignore for various reasons. Tell me about that transition and using all that skill, knowledge, expertise that you acquired in this universe.
Yeah, no, it was, as I mentioned, it was an incredible opportunity I happened upon. So once I graduated from Tulane, I moved out to California and worked for a private equity firm called AGR. And at the time, they were buying minority ownerships in privately owned businesses. Most of them would be family-owned businesses that wanted to remain in control, but take some chips off the table. I think for the most part, that's still the strategy they run. But looking back on it, it's very, very similar to the same due diligence you do in on the public equity side, because you're not replacing the management team. You're not doing what traditional private equity does. So, and this, the second way I got super lucky, I would call it, is that it was a large fund, but there was a really small deal team. There was only, I think, 5 or 6 people on the deal team. So I got to do anything and everything. I got to visit all the management teams, talk to the industry experts, go to all the conferences, and just really talk to competitors, just fly across the country and really do the rigorous due diligence that anyone would do if they were going to buy 30 to 49% of the company. And, so when I started my fund, it was just already innate in me that I'm going to do the rigorous due diligence, even if I'm only buying 1% of a company. I'm going to treat it as if I'm buying 39, 49, 100% of the company. And I kind of thought that's how everyone thought about it. And so, and maybe in larger spaces they do, but, I think I told the story in the last letter I wrote to my investors where, the first company I visited, I flew out, I was wearing a coat and tie, I dressed up all nice, and I walk in, and the first 10 to 15 minutes, they're wondering why I'm even there. It's $100 million market cap company, and they can't believe, they're like, why are you visiting us? No one has been here in 5 to 10 years. So I thought, okay, well, maybe investors only go to the annual meetings. Maybe that's what it is. Maybe that's what I'm missing out on. So I went to the annual meeting, happened to be 2 months from then. I went to the annual meeting and I was one of 2 other investors. So it clicked pretty immediately that this was the way I was going to provide value to my investors, is going into these undiscovered companies or overlooked companies and doing the same rigorous due diligence I was doing at private equity. And I just realized barely anyone is doing this. And I was pretty blown away at because I had already seen the companies we were buying ownership in private equity would be considered, for the most part, microcap companies. So I'd already seen that smaller companies were inefficient or inefficiently priced. on the private side, I was shocked to find out that it was even more inefficient on the public side. And some of that's for good reason, but some of that is just because it's simply overlooked, like completely overlooked. And if you do boots on the ground due diligence, you're quickly going to become the person that knows the most about the company. And it felt to me like that was the best way I could provide value to my investors.
When I heard you say that when we spoke, to me it was mind blowing that there are publicly traded companies that nobody visits.
Yeah.
I
It
still have
really,
a hard
yeah, it
time.
really
But,
is. Yeah.
but I think throughout this conversation will become more obvious why and the context around it. I don't want to give it away just yet.
Yeah.
Your story reminded me of Buffett's Mungers and the whole Ben Graham crew that would go visit companies. And everybody knows the legendary story of Buffett getting on the train and going to the next city or traveling around the country and going to visit companies. And he would wait in the lobby until somebody would see him. We don't do that as much anymore. I think there's a lot to it beyond this conversation, regulations and so on, how much the management can share and all of that. But anyways, checking on the company and actually seeing it in real life, I think that's very helpful. Brett Gardner, you might know, who wrote a wonderful book about the early investments of.
It's right
There you go. You have his book. Yeah. Brett, we're talking about you. But anyways, he did an incredible job in that book, telling stories just like yours of Buffett, young Buffett, going to those meetings and meeting a lot of other people from Graham's circle at the annual meetings, and even skipping a class or two at Columbia to go to those annual meetings. Brett did an incredible job. Highly recommend to read the book for anybody interested. I want to dive in the in-person advantage, meeting the management. So when we're investing in publicly traded companies, over the years, I got to meet a lot of CEOs. I was in the room with them. I had one-on-ones with them. I was also at bigger events and annual meetings and shareholder meetings. I feel like it's precious to understand who is running the business and how they operate and what their incentives are. You go face in face, you talk to those individuals. Can you tell me more? What are you looking for? What are you seeing? And from what I understood, you're looking for really good capital allocators, and they are out of sight. They're not on covers of any magazine, but they exist.
Yeah, it's I really enjoyed Brett's book. I think it really opened a light on how Warren Buffett would run a fund if he had, a small sum of capital, and how he did run a fund.
Yeah.
I think a lot of people envisioned that he was just going through the manual, circling companies that were at a 5 PE ratio and then buying those companies. They don't really think about the rigorous due diligence he was doing. And I thought that book was great at highlighting it. Some of the stories I had already heard, but a lot of them I had never even read before. And it was super interesting. So, yeah, I mean, for me, I think the pushback I've always heard is be careful visiting management teams, because if someone has become a CEO, they become very charismatic and they can sell you very easily. And I don't think you run into that problem too much in microcaps, or not to that degree. And what I really learned, and we could dive into it later, but it was really the most important flight I think I've ever taken for the fund is about a year into the fund. I flew out to Fort Worth to meet with Dayton Judd. And when I sat down with him, I had already known this, but I started to realize there are A+ CEOs in the microcap space. Don't get me wrong, they're few and far between. There might only be 25 to 50 in the US that, can hold a candle to Dayton Judd. But I mean, really what I am diagnosing, I guess, for lack of a better word, when I sit down, is that what Dayton did was he spoke to me business owner to business owner. And, that's what it is. Dayton, and, this is one thing I 100% look for. Dayton owned over 50% of the company. So he was definitely a business owner. And, so was I. And, he told me, here's what we do right. We're great at cutting costs. We're great at making acquisitions at low multiples. We're great at, various other things. I mean, he knew the business inside and out. It was, I mean, just quickly speak on Dayton. He could run a Fortune 500 company if he wanted to. But he also told me everything that was going wrong as well.
Mm-hmm.
We need a new ERP system. We need to updates in this area. We need to work on, parts of the financing. And, he really spoke to me. If I was thinking about it, if I own 10% of a restaurant here in New Orleans is the example I often use. If I sat down with the 90% owner, he spoke to me how that 90% owner would talk to you. He didn't, it wasn't fluff. And a lot of times you sit across from a CEO, and especially in the microcap area, and they're basically just giving you a pitch that this is going to become the next Tesla or Apple, and we have no flaws in the company. And that's just not true. I mean, especially in microcaps, there's going to be a lot of flaws within the company. And even in the largest companies, they're still doing things wrong. So it was what I'm really looking for is, it's not a sales pitch. It's a business owner to business owner conversation. And I think, I'll try not to read too many quotes here, but I think Jim Collins defines what I call an A+ CEO, what he calls a level 5 leader. And the quote in his book, Good to Great, it's that they have a leadership style that is characterized by a powerful combination of personal humility and professional will, meaning they are highly ambitious for the organization's success, but with a modest and self-effacing attitude, prioritizing the needs of the company over their own personal gain. And when I sit across a CEO who's like that, will do anything for the company and is not focused on their salary, just collecting a 9 to 5 check and going home. It makes, and to be honest with you, I probably only find one per year. 3 would be an incredible year. But it makes all the traveling I do worthwhile, is because when you get an A+ CEO like that in a microcap company, and we can dive into that later, but the returns can be astronomical. And the second part I'm looking for is just the culture of the company. And I think you can more diagnose that part by going to the shareholders meeting. And a company I've owned for, I believe, around 4 years now, Citizens Bank, is based in Atlanta. And when you go to the shareholders meeting, you can tell the board, the CEO, the CFO, the COO, all the lenders, everyone is on the same page. And there's a culture throughout the company that everyone is aligned with. And so those are the two things I'm really trying to diagnose, because as I think we'll dive into later as well, the importance of the management team for a small company is just off the charts. I think it's 90+% of the success of your investment is going to rely on them.
Well, I'm going to add here, I have this quote from you that the importance of a management team is inversely proportional to the size of the company. I think it's a very powerful statement. I think it's intuitive that if you have a large company if the CEO fell asleep and went missing for a week, it would continue to run. I don't know if it would run forever without a CEO, but it could run for a while.
Yeah.
I can imagine a smaller business, if the CEO goes missing, will know about it. The business and the customers and the suppliers will know about it a lot sooner. And obviously that's on the downside. And if they're doing a good job, you'll see the benefits sooner too. I manage money for families, and I get to hear all kinds of stories. These are often family fortunes built over generations. There are periods that those families experience of high cash flow generation, and that cash flow was deployed. But the businesses they operated in many cases were not public. So I have a question here for you. The companies you look at, why are they public in the first place?
Yeah, it's a great question. And it's a question I ask. That's probably the first question I ask every company when I go visit them, is why are you public?
Yeah.
And, most of the time, to be honest with you, the company went public prior to 2008, 2009, and they just haven't wanted to change. And there's pros and cons of being public versus private. You know, if you're a public company and you have a diverse base of shareholders versus one private equity firm controlling you, there could be pros and cons there. But almost always it's because they went public before 2008, 2009, because the costs of running a public company have really ramped up since then. And you know, it's going to be $1 to $2 million just to throw out a rough estimate to run a public company. So when you're $100 million market cap company,
Yeah.
that's a serious cost. And sometimes that can be your advantage if you can raise equity quicker. There's some pros, but I would say most of it's cons. And so it's I think, you know, we'll probably talk about later, there's definitely an interesting dynamic here where some of these excellent companies can get taken private and further down the road and cut out those costs. But yeah, it's the first question I ask every time, and there's never ever a like, oh, that makes perfect sense answer. It's more just, you know, we've been public for so long that we've just remained public. Our employees own the company, and you know, it's just they don't want to rock the boat. And I think they fear what private equity would do as well. You know, that it would completely overhaul the business, and in some cases, perhaps that's what they need. In some cases, the business is being run perfectly fine. Where, you know, for instance, going back to FitLife, that's owned 55% by Dayton Judd. He's the best person to be running it by far. And if it was to be bought out by private equity, who knows what would happen? Obviously, at a certain price, you just say yes. But it's the question I get the most, and it's the question I ask the most as well. And I would say going public now, if you were $100 million market cap company, it's oftentimes does not make a lot of sense, to be perfectly honest. The costs have just really ramped up. And, you know, I think as over-the-counter markets gets more professionalized, it's become a whole lot more professionalized. Even in the 5.5 years I've been running the fund, hopefully these costs will come down because I really do think there is an advantage to having this outlet to raise money for smaller companies. Because in Canada, if you look at the TSXV, the Toronto Exchange Venture, there is a ton of companies, and it's very reasonably priced. And you'll actually see U.S. companies go list on the TSXV and just own all U.S. assets. So there's a way to do it. We are being way too burdensome on smaller public companies right now in the U.S.
No, that's very encouraging to see more companies. I think overall, there are fewer listed companies in the world, in the US, than we had 10, 20, 30 years ago. I have a couple of quick questions before I proceed. What is a microcap, small cap these days? Just, I didn't ask it, but I think it's pretty important for this audience. How big is that?
Well, I guess I could just give you the largest company I own is about 600 million market cap. And the smallest company I own is about 30 million market cap. So there's 15 companies in the River Oaks Capital portfolio, and the average size is 250 million market cap. I would say most people, when I first started, it was 300 million was kind of like the target. I think now it's probably been pushed up almost to $1 billion, just as all companies have grown in valuations. I would say anything under $1 billion is probably considered microcap at this point, or at least under 700 million.
No, that's
but
fair.
Everyone has their own definition, if I'm being honest.
The number keeps on changing, and it has changed in my 20 years in the business. So that's why I ask, what is it these days? Because the number keeps on changing. Yeah. I don't want to miss that point that you brought up. I think it's really important. When you talked about the CEO, I wrote it down, a thought that what we really want is somebody or something that money cannot buy. You want somebody that's doing something
the right way for the right reasons for the business. And it's not because of some very well-defined incentives where this vests or that vests and they get this much or that much that quickly or that soon. You want somebody, and I know it's a huge ask, but you want somebody that you describe that just has to do the right thing. They love the business. They put the business first. Buffett has done it all his life. We meet people like that and hear of people like that. Some of them are on the covers of magazines. Some of them we've never heard of. But
Yeah.
if you find somebody like that, and it's not just the CEO, you probably want a doctor in your life like that, an accountant, and an investment advisor like that.
Yeah.
That's not doing it just for the paycheck. Yeah, they have to pay the bills and send kids to school, but you want somebody that loves it so much, they have to do the right thing. And I know it's a huge ask, but if you can find somebody the way you describe, I think it's a huge win. I want to ask you about this idea of a sweet spot that you find in microcaps, that they dominate an obscure market. So we might not even know that it exists. And I would rather you not mention particular companies since they're smaller. But
Yeah.
if you can give us an idea of what you found, how you found it, maybe an industry you can describe, that you find something like that. It's an obscure opportunity, but somebody dominates it. And given the size of that opportunity, it won't be a $1 trillion company, yet it's still interesting.
Yeah, I think this was one of the biggest learning experiences, other than finding it, other than an A+ CEO is 90% of the investment return, is looking for obscure markets. So, I mean, my favorite thing that happens is when I hear about a company and I realize I didn't even know that industry existed. That is my favorite thing that happens. And, I think what most people are looking for when they're investing in mid cap and large cap companies would be what Warren Buffett defines as a moat. Something that's protecting this company so that they can make above average return on capital and become an excellent investment. I think, the thing, Coca-Cola often pops in my head, American Express, those types of companies. I mean, the reality is if you're $100 million market cap company, if Amazon decided tomorrow they want to compete against you, there's nothing you could do about it. They're going to outcompete you. So I mean, in my view, the reality is to have a Warren Buffett defined moat in a microcap company is near impossible, just because you're not going to have the capital to stop a major competitor from coming in. So what I'm really looking for to use the moat analogy is more of a remote island that's so far removed and so far away that it's not even worth the time of a major competitor to sail there and try to conquer the island. What they would rather do is just buy out the entire island for a high premium. So, I mean, if I'm thinking of $100 million market cap company, let's just say they have $100 million in revenue, but there's a pretty clear growth path to $300 million in revenue, or maybe even $500 million in revenue. That could be, if that happens, that will be an incredible return for a microcap, for that company.
Right.
For a mid cap or large cap company, that would move their revenue less than 1%. So it's not worth the R&D, the marketing, and all the just brain drain of trying to even compete against this company. They're in such a niche, obscure market, and oftentimes by being in this niche, obscure market, they've mastered it as well, and it's not something you could just hop into. So, worst case scenario, in my view, is that if a major competitor identifies this obscure market and finds it and says, oh, wow, this is actually a very interesting market and we want to be a part of it, they're just going to buy out that company at a major premium. And maybe you miss out on a little bit of the return that could have come to fruition. But I mean, that's how I view it. It's just a remote island, because having a traditional in a microcap company is an extremely hard task, just based on the limited access to capital you have.
I think it's a brilliant way to explain it. The other side of the equation, when you think of a about an business opportunity. You find something that you can earn a profit selling or offering. There are other people that will want to do what you do. If you have a very successful lemonade stand, the neighbor will notice and have their kid set up one too, right?
Yeah.
And that's the reality of a free market economy. Once
Yeah.
we notice, hey, he's selling t-shirts, I should be in the t-shirt business too. So it's not that the whole world will let you have that profit. No, the whole world will figure out how they can have a piece of the pie that you identified in
Yeah.
a market they might have not even thought about. So when I'm listening to, I'm thinking two words: small and unknown, right? Obscure, in the sense that very few people might even know that this market exists. And even if you told them about it, they would say, listen, the addressable market is this much. I'm operating a $200 billion company.
Yeah.
I don't really have the bandwidth to go after this opportunity. So you have the size and then it's unknown. And it creates this silent advantage. I'm sure there are other competitors in that space that are looking at it, but Amazon actually would probably not consider a lot of different market segments because it's just too small. They can't scale it, and it might be very localized, or for other reasons, there's not a good opportunity to grow it.
Yeah, and I think the one thing that people often miss when they're analyzing return on investment, or however you analyze what a successful business is that they're often looking for a company that's making 40% return on investments,
Right.
but they're not thinking about how long they could do that for.
Yes.
So a lot of these, maybe they can make a 40% return on investment, but it's only for 4 years. And then, as you mentioned, capitalism takes its way and everyone starts diving in. And then that 40% goes down to 8 to 10%, and you get a traditional equity return. And these obscure markets, you're probably not making a 40% return on investment. Maybe it's only 20%. But you could make it for 30, 40, 50 plus years just because no one's paying attention. So it's the duration of a slightly above average return that's really could be attractive in these areas.
I wrote down, the length of the runway and a concept that I've been thinking about more lately, which is the incremental return. So the new capital, if you deploy it today, what's your opportunity as a CEO right in front of you today? Because a lot of the work that we do, when you pull up a statement and you do your analysis, you calculate the ratios, you're looking back.
Yeah.
And I think Bill Miller, I had Sam Mecklemore that worked with Bill for many years tell me this story, how they were at an investment meeting and Bill pointed out to somebody, you're telling me all of this about the future. Where are you reading this in the filing? Because the filing is all about the past. The future is what you think it's going to be, right? It's not in the filing.
Yeah,
But that's
100%.
that's where the money will be made, right? So if you're deploying the extra $1 million, are you getting the 40% that you were getting until last year? Or are you getting 15 or maybe 5, right? And what you're describing is long runway that you can deploy at a decent rate for a long period of time, something we don't think about. There's a value in that. You have this approach. I hope I pronounced this correctly. Suggestivist approach.
Yeah.
You visit the management and you have some ideas for them about the use of capital and more. Can you explain for the benefit of the audience how this approach works?
Yeah, 100%. And I don't think I coined that term. I'm actually not sure where I got it from, to be honest with you. So whoever I stole it from, I apologize. But yeah, I think it was about 2 to 3 years into running the fund, into running RiverX Capital, that I realized. Well, first I realized microcap markets are incredibly inefficiently priced. I was finding companies, like FitLife, that were trading at under 7 times earnings, and you just weren't or I wasn't finding those opportunities in larger areas of the U.S. market. But it dawned on me after running the fund for, I think it was probably at the end of year 2, that just because they're inefficient now doesn't mean that one day they're going to become efficient. They could remain inefficient for 15, 20 plus years, and the share price could never move. So I realize whenever I buy ownership in a company, I visit them once a year and talk to them at least once a quarter. And I realized the first 2 years, what I was really doing is I was just assessing their trustworthiness, their capability, and that sort of qualitative aspect. I was not approaching them with suggestions on how to return capital to us shareholders.
Mm-hmm.
And I kind of just I flipped a switch there where I was like, if I want to try my hardest for my investors to generate a double-digit return per year, a lot of these companies are going to have to take advantage of their mispriced stock.
Right.
And so I'm not flying to visit these companies. If it's a bank, I'm not saying you should lend to this company. I'm not telling them anything about their operations at all.
Mm-hmm.
But the pitch I'm often giving is, right now, I know you're looking for acquisitions,
Mm-hmm.
and most of the acquisitions you're looking at are 10 plus times a PE ratio or 10 times earnings.
Yeah.
Your company is currently trading at 5 times earnings. Why not buy more of your own company at 5 times earnings? And I think it often clicks when I say that. And it's actually been way more successful than I thought. A lot of the companies that I've flown out to visit have announced a share buyback program. I'm not saying all of them by any means. But, what I realized was a lot of microcap companies are getting frustrated by the mispricing or undervaluation of their companies. And what they should really do is look at this as an opportunity.
Yeah.
There's no other area in the U.S., I think on the public or private side, where you're getting an opportunity. If your company is trading at 50 cents on the dollar, which a lot of microcap companies are, you're getting almost a layup capital allocation opportunity to turn $1 into $2. And, it just doesn't exist anywhere else. And so that's really what my suggestivist approach has been, is just bringing that to light. Because I've noticed a lot of these A-plus CEOs we invest alongside, they're so in the weeds of running their own business and reinvesting into their own business that they don't put that much time thinking about returning capital to shareholders. And it's, if you could just highlight that for them is, you have $10 million of cash sitting on the balance sheet right now. Why not buy back 10% of your company? And, I think, part of this has just been experience and realizing that I need to put my foot forward and really press them to do this. Part of this has been, a company we own called Medical Facilities. I watched them over the last 2.5 years buy back 50% of their company. And I had it in my mind, and I think a lot of people do, that it's too hard to buy back shares of microcap companies because they're illiquid, and it's just not worth the time. It's going to take forever. And I've totally changed my opinion on that, because if you really want to buy back your shares, you can find a way. And and so that's been my approach. Or the second aha moment I had. The first aha moment I had was go visit management teams in person, do the rigorous due diligence that we were doing on the private equity side. The second aha moment was become a suggestivist investor, and so that you can take the equation out of relying on the market becoming efficient one day.
I think it's a brilliant revelation here. And as public shareholders, we analyze the business and we look at it, but the price movement, it's part of it. We think when you look at it, you can't avoid it. But when you're on the inside of the business, especially if it's a smaller company, I think there might be times that for a while you just don't know what the stock price is because you're busy. The supplier is calling you, the customer wants the shipment, there's a new employee you have to train. I mean, there's 1,000 things that it takes to run a business, especially a smaller business. So
100%.
Tony Deedon, who was a legendary investor, had this story how he would ask a founder, he owned the shares of the company, and the founder would ask Tony, where does the stock trade these days? Clearly, he had no idea where the stock price is. And I think, you could see it as a joke, but I think it's an eye-opening revelation that they're so busy running the business, especially folks that don't have their compensation so tightly connected to earnings per share and stock performance and investing schedule and all those things. They can actually focus on the business. So I know there's CEOs that know exactly where the stock closed yesterday, and now I know CEOs that have no idea where the stock's traded the last week or two or a month. And I think there's a sweet spot somewhere, and they might need somebody like you that tells them, listen, it looks like your stock is half off. Maybe you should deploy your capital in a different way.
100%. Yeah.
I think they value that. There are times when things don't go right. I'm sure there are a lot of opportunities in this space. You talked about margin of safety. I want to dive in a little bit deeper. There are surprises, there are changes. These are smaller businesses. A lot can change. Obviously, there are competitors. Obviously, there is a lot of internal dynamic going on. You might end up losing money. How do you think about some setbacks? How do you think about the situation where the price goes against you? When do you double down? When do you cut losses? How do you think about it? I think you really have to pay attention to that front, managing a portfolio in that space.
Yeah, I mean, it's inevitable you're going to make mistakes. I think my favorite Charlie Munger quote is investing is hard, and if you don't think it's hard, you're stupid. It's, it's a great quote, but it also it sums up his personality in one entire quote. But, my rule of thumb is that I have a when to sell list, and it's three things. It's the first is if I've misjudged management team or they've been dishonest. If in any way they've lied or I've just misjudged their capabilities, I will sell immediately. Obviously, in microcap companies, it's a little difficult to sell all of it in one day.
Yeah.
But I'll slowly start to sell. The second one is if they take a hard left turn. And the way I think about that is going back to using the restaurant analogy. If I was to buy 10% ownership of a restaurant here in New Orleans, and they call me tomorrow and say, actually, we're going to start building water parks. It's like, okay, I good luck, but I'm off this ride. And then the third is if the price just gets so high that it makes sense. It would be a disservice to my investors not to sell, even if it makes you look short-term minded. If it gets to a 50 PE ratio that will never grow into, that would be the third reason. But I think what's super interesting about microcaps is I do think it presents an opportunity that is not presented anywhere else in publicly traded U.S. companies, where it can go down 15% in one day. And it's strictly because someone woke up that morning that owns 5% of the company and decided they want to build a pool, or their kids are going to college or something of that nature. So it's obviously very it will jaw dropping to wake up and see that your company is down 15%. But if you've done the rigorous due diligence, you've talked to the CEO, you've talked to the management team. I mean, you, as I said, you probably know the company better than anyone else. And what that's really presenting to you is an opportunity to average down when nothing materially has changed within the company. And I can't think of too many other areas, if any, in the U.S. markets where that opportunity isn't presented to you unless there is some sort of panic or more macroeconomic event unfolding. Whereas here, I could think of multiple companies we've owned that have gone down 15%, and I've found out later that it was just because one large shareholder needed liquidity. And it presents you this opportunity, as I said, to average down. And almost all of, if I look back on all of our best investments, it's almost always we've bought our initial ownership, and then we've had opportunities to lower our cost basis as it goes on. Obviously, it's not comfortable. But if you know the business better than anyone else, it's presenting you an opportunity that you can't find elsewhere. So it's obviously something you need to monitor, but it's a really unique situation that can pop up.
I want to highlight that, but it's that big overarching idea that when the price dropped, it's actually a lower risk.
Yep.
assuming that everything else with the business is more or less intact. And I have to emphasize the other thing. In that space, even more so than in the broader public market universe, it's a reminder that the price volatility is not a risk, which goes against the efficient market hypothesis and modern portfolio theory that I'm not going to bore this audience with. I'll let them read it whenever they feel comfortable. But
Yeah.
price volatility is not risk. What some of us have been told or taught or heard. The risk you're looking at, you bought the business, you were wrong about it, the management lied to you, they pivot in the wrong direction, they're allocating the capital in the wrong way, or the stock just becomes overvalued, overpriced, and you want to exit. But the journey, how do you get from here to there? It could be a bumpy road in that space. It's a liquid, it doesn't trade too much. The news flow is very different. There's no coverage of those companies, or very limited to my understanding. And you have to assume that the price discovery is not working as much as a company that's probably watched. But I have some thoughts about big publicly traded companies. I don't think they're as efficiently priced when we see 20% gap downs overnight. I think it tells a story, but that's for a different episode. I want to ask you a big question about capacity. And given the approach that you have, I think I have to ask that. But there is a limit, and you're very disciplined about it. You can't manage, $50 billion in this approach. You have that understanding. And tell me about that, because it's quite unique in the universe where a lot of managers think that the more assets, the better for you. And I think that was Buffett's realization at some point too. I can't manage $1 trillion this way.
Yeah, 100%. I think so. It's it's definitely a balancing act on the microcap side.
Yeah.
Because as my fund grows, we have more pull on the suggestivist investor side. As we go from owning 3% of a company to 5% of a company to 10% of a company, you have more pull of saying we need to buy back shares. Maybe we should consider uplisting onto the NASDAQ. Certain things that might make sense at the time. But then you reach a certain point where your fund has gotten too big, and what size that is, I can't really put an exact number on it. It's probably somewhere over $100 million. Where all of a sudden, if you've either just can't buy microcap companies anymore. It's impossible.
Yeah.
Or B, you're stuck in this situation where if you did make one of the three mistakes that I mentioned and you become a seller, you're either going to have to sell at an extreme discount, which often is why you'll see a 15% sell-off, is you'll see it's because a microcap fund is liquidating. Or B, you'll have to become an activist investor, and to try to recover or change the corrections in the company that have gone wrong. And that's not really a place I want to get stuck in. So every time I'm raising more capital, which I'm actively doing right now, I'm pausing each step of the way and saying, am I hurting my existing investors or am I helping them by doing this? And I think at this stage, it's actually helping because we're getting more sway with the companies that we own. But there's definitely a tipping point where you go from helping your current investors to hurting your current investors. And a lot of my current investors are people I have Thanksgiving. My first investors are people I have Thanksgiving and Christmas dinner with, and then all of my investors have been incredible, to be honest with you. And I'm really in this to protect them and ensure that they're getting adequate, hopefully double-digit returns. And if the goal was to make as much money as possible, I wouldn't be paying attention to microcaps as far as me personally as the asset manager. So I mean, what it really is for me that's exciting is finding these mispriced opportunities. It's like it will make my year when I find that plane ride home. It's like I'm on cloud 9, and I don't really want to price myself out of that. I really enjoy it. There's plenty of space to make a great living. and make great returns for your investors. So that's how I think about it. But I think you do have to be careful in stopping every time you've started to raise money and just making sure that you're not hurting your initial or prior investors, because they're the ones that backed you in the beginning when the fund was just on its feet. So you really have to take that into consideration.
I think it's a principle that applies to all people managing other people's money. We might forget about it, but I think it's valuable to remember the quality over quantity approach, where you decide to choose how far you want to grow. And then having great clients, you mentioned it. I think it's very important, not just in this business, I think in many, but especially in this one, where it's all about trust. And it's all about them staying with you through hard times and investing. There will be hard times. There's no question about it. There will be ups and downs. And having the right client base, I think it's very important. I want to ask you about something you brought up briefly, uplisting strategy. And I think it might be an unfamiliar territory for this audience. I'd love to explore it because we find this investment, it works out, you add it to it, all good things. And at some point you want to exit. And you open my eyes to the concept of uplisting. If I've heard of it, I forgot. And listening to you and talking to you the other day, it was a phenomenon that I wasn't aware of. I can talk about companies entering an index on the larger side that changes the dynamic. But here it's kind of a similar, it rhymes with that story. But what is uplisting? How does it work? Why do you benefit? And why does a company of that size benefit in that case?
Yeah, so most microcaps will start off, not all, but most will start off on over-the-counter markets.
Yeah.
Which even give it a name, it's very professional now. They'll have certain tiers, and the top tier of over-the-counter markets is, I find it to be almost as professional as the NASDAQ. I mean, almost, I believe in order to be on the top tier, you have to be SEC registered. So you're getting audited financials, you're getting everything. The problem is that most, if not all, institutional investors just simply are not allowed. The mandate does not allow them to invest in over-the-counter companies, which presents an opportunity for funds like River Oaks. But it also, you reach a point where you need those institutional investors to step in. And, I hate to keep using names, but it's the best way for me to give an example is FitLife. They got to the point where they completely professionalized the business. They put an ERP system in. They're registered with the SEC. They had gotten the proper CFO, the proper management team. Everything was in place. But every time someone would call Dayton and say, I love your company, but I am not allowed to invest in your company because it's traded over the counter. So if you go back and see, I think it was about 18 months ago, they uplisted onto the NASDAQ, and it does cost more. If you're already SEC registered, I don't think it costs as much as people think. I think it's only a couple $100,000. The problem is then sometimes the board starts asking for more fees because now we're a NASDAQ company instead of a counter company. So it's the number is a little hard to quantify.
Yeah.
So you have to sit down and weigh the pros and cons. What does the pros of attracting institutional investors outweigh the cons of increased costs? And for FitLife, the answer has been 100% yes. Their stock price has gone up over 50%, I believe, since they've uplisted onto the NASDAQ, because there was all these institutional investors looking at this company and saying, I'm sure they were buying it in their personal accounts, but they were saying, I would love to buy 2 to 3% of this company, or if not more, but I can't physically do it. It's literally mandated that I can. And there's also a lot of brokers that won't allow you to buy companies that are over the counter as well. So there's definitely, you have to sit back and think what makes sense. It doesn't always make sense to uplist because, as I said, the cost will increase. But in my observation, a company if things are going right, they just naturally grow into needing to uplist. And that's the best case scenario. You don't want a company that's uplisting because they need to raise more capital and or something of that nature. It's just they've reached the point where it's okay. It's now time. We've now reached that point where the pros are going to heavily outweigh the cons of uplisting. So yeah, it's an interesting dynamic to think through
Mm-hmm.
because I am investing in have ownership in companies right now where it makes more sense for them to be over the counter. Because they have a solid investor base. They don't
Mm-hmm.
need to raise any more cash. The company is generating tremendous amount of free cash flow.
Mm-hmm.
They, and it just makes sense to run the company as lean as possible. And then some companies, it's the exact opposite. So it's an interesting dynamic to think through. And, one that it's interesting to watch.
It's case by case. I'll mention that any stock we might have brought up in this conversation, no recommendation, do your own research. Obvious,
Yes,
but I'll mention
100%, especially for microcaps. Yes.
it. But the uplisting, many things happen, but one of them is more liquidity, right? More people can participate, so it's easier potentially to sell. That's a thought.
Yes.
But
Yeah.
it immediately made me think it's yet another step or hurdle in the broadly defined public equity market. The participation in an index or being in a member of an index being the other one, where stocks that are not a part of an index or fell out of an index somehow get completely forgotten.
Yeah.
The coverage dwindles, they're not in the news, and the business might still be just fine. It's just they didn't make the cut because there's a limited number of seats available.
Yeah. And that's one part I missed out on too, is weighing the pros and cons.
Yeah.
Is weighing would you be included in the Russell 2000 if
Yeah.
you were to list on the NASDAQ, because
Yeah.
they won't include you if you're over the counter.
Yeah.
So that's it's that would be on the pro side for sure.
That's another consideration. I want to ask you about the most counterintuitive lesson about microcap investing that you wish more people understood.
Yeah, I mean, so the first one that comes to mind we've already talked about is that when the price goes down,
Yeah.
very, very often returns actually, or your future returns increase.
Yeah.
And it's very counterintuitive for
Mm-hmm.
most people. Most of the time when the price goes down, you want to just curl in the ball and just hope that it somehow goes back up.
Yeah.
But as I mentioned, if you're doing the rigorous due diligence, if you're getting on the airplane and flying to the company and visiting the company once a year, talking to management at least once a quarter, talking to the board, talking to other major investors, when the
Yeah.
price goes down, you're going to have a pretty good idea whether or not it's business related or something totally unrelated to the business, a forced seller. And really, in order to be successful in microcaps, you have to capitalize, in my opinion, you
Mm-hmm.
have to capitalize on those opportunities when the price goes down unrelated to the business. I think the second thing that's perhaps counterintuitive, or it was for me for a while, is that as we mentioned, as I look back on the last 5.5 years of running the fund, I would say almost the only thing that all of our successful investments have in common
Mm-hmm.
is that it was run by an A+ CEO.
Mm-hmm.
It was not how much I paid for the company.
Yeah.
It was not they were in the right industry. It was
Yeah.
not any of that. I mean, obviously, there's a certain price where if you pay too much, but that's not my DNA. So that problem I don't run into. But the most common and the only common theme between all of our successful investments has been having an A+ CEO. And I think why that's so important in the microcap industry
Yeah.
is because when you find these obscure off the beaten path markets, almost always the other players in that industry are going to be C minus CEOs,
Mm-hmm.
who are just collecting a 9 to 5 salary.
Yeah.
and they're not interested in growing the business. They don't have that entrepreneurial spirit. So if you plug in an A+ CEO with an entrepreneurial spirit, that's, a level 5 leader that
Hmm.
Collins refers to, they're going to run circles around their competition. And they, as I said, they don't even need a moat. They just need to be on a remote island running circles around their competition. And that's a lesson that took me a while to learn. And the counterintuitive part of it, which was a hard pill for me to swallow, I guess, is that it's okay if that CEO is getting paid twice, or if not more than twice, than all of their competitors, because
Interesting.
the
Yeah.
return you'll make is way, way, way more than the slight increase in SG&A that goes up from hiring a CEO. So, I mean, obviously, you have to be careful that the CEO isn't just overpaying themselves because they own a ton of the company and they're friends with everyone on the board and they're just giving themselves a nice salary. But if
Sure.
it is an A+ CEO, I think it's
It's worth the
100%.
money.
It's worth the money. And then the last thing about microcaps that I think is counterintuitive and goes against all the investment advice I learned when I was getting my MBA is that I don't think, this is my personal opinion, I don't think indexing in microcaps makes sense. And obviously, take it with a grain of salt. That's coming from an active manager in microcaps. But I think when you think about indexing in mid caps and large caps,
Yeah.
what you're really, the real problem you can run into in mid caps and large caps for the most part is just that they're overpriced.
Yeah.
In micro caps, I would say 90%, unfortunately, of the companies, there is a near 0% chance you're going to generate an adequate return. Just because either the management team isn't aligned with you, they're just
Mm.
trying to get as high a salary as possible, pay the board fees, and then what happens with the excess cash, they could care less. They're trying to penetrate a market such as, they're trying to become the next electric car or something like
Yeah.
that. They're trying to penetrate a market that a microcap should not be trying to penetrate.
Yeah.
So if you do your due diligence and you visit these companies, go to conferences, talk to management teams, you can eliminate, I think, 90+% of microcap companies just right off the bat. And if you
Hmm.
index that, you're going to be capturing all these companies. And I think a lot of people think, oh, I'll just take a VC approach towards microcaps. And the one company that, shoots through the moon will offset all of these 90+% companies that are just,
Sure.
never going to make an adequate return. And I haven't seen that actually work. I do think, again, as I said, I'm an activist or an active manager, so take it with a grain of salt. But I do think that being actively investing in microcaps is actually the strategy that makes the most sense.
No, I'm glad you said that. And it's very humbling because it's a very, very tough universe to operate in. And there's so many considerations that maybe you can pay less attention to in the established big, large cap universe. But you really have to pay attention. I like the point you made. Most of these investment opportunities in that space will not work out. So you
Right.
have to be really, really careful about what you choose and how you choose it. And you devoted your career to doing it. And I really appreciate you sharing that. I have one last big question for you. How do you think about success?
Yeah, it's a deep question in a lot of ways. It's a simple question for my investor, or for how I think success for my investors is just getting a double-digit return
Yeah.
and making sure a double-digit annualized return, and making sure that I do my best for them to deeply understand each company we own. Because if they deeply understand each company we own, when there is a sell-off,
Hmm.
there won't be a panic amongst my investors as well. We will be able to, I'll be able to communicate with them, and they'll understand the business enough to know, oh, there's nothing actually wrong here with the business. And, ironically, if you are the best company in a niche underfollowed market, downturn in the market ends up, if you're long-term minded, ends up being a good thing. That company often will gain market share. It will wipe out the marginal players. So if the success for my investors is pretty clear cut. Success for me, I think, I've thought about this a lot, is just remaining passionate and curious about investing.
Yeah.
Um, I'm not sure if you've ever tried to compete in other areas against someone who's passionate and curious, and you're not.
It's tough.
It's just impossible to compete against them because, and I'm not even necessarily sure if this is a good thing or a bad thing, but when I'm going fishing on the weekends, when I'm exercising, when I'm doing jujitsu, when I'm just hanging out watching sports, I'm thinking about investing the entire time.
Yeah.
And it's just, I'm just super curious and passionate about it, and I just want to always remain that way. And so that's really how I define success for me. And I think I have a good story to define this is which links in John Rotani, who I brought up, who's a mutual friend of ours. And so John and I were on a board of an investment conference here in New Orleans, which is not a very large conference. There was probably 100 people there. And sitting front row was Bob Robotti at this investing conference. And I'm not sure the exact age of Bob. I'm not going to guess, but I hope that when I'm his age, I am flying to go visit obscure investment conferences in New Orleans with only 100 people, and he's sitting there in the front row taking notes.
He loves it.
It was,
I know,
it was
Bob.
unreal to see, to be honest, and it was really, and it's the common theme I've seen amongst all successful investors is they're still extremely curious and passionate about it late in life as well.
I've met quite a few people that continue to invest way past the traditional retirement age. And I'll bring it up super quickly. Buffett announced his retirement this year. And I was there listening to him. And if you pay attention, and I had a conversation about it with Matt Ziegler, that's an episode that he aired on Excess Returns. I aired it on Talking Billions. At the end of it all, Buffett says, if there are a lot of opportunities at some point in the future, I am a major shareholder, the board can call me. I'll come back and help out, right? Not in the active sense of taking over as a CEO again, but he loves what he does so much that if there is a period of a lot of opportunities, he wants to be a part of it. And what I saw is just somebody that you just described, that we all, I feel we are. We love what we do. We can't really see it as work, and we definitely cannot imagine stopping. And it's a beautiful thing. It's a gift. I feel very privileged that I found something, and I can tell you found something that you would do, even if you basically are not doing it for the paycheck. You do it because you enjoy the process, and it's a bonus that there are people that value what you do, what we do, and there is a paycheck that follows. But I think the joy of the process keeps us going, and the fact that we're changing people's lives. That's how I see it.
Yeah, I was at the Berkshire Hathaway meeting as well, and it was obviously sad, but at the same time, you could tell he could not fully commit to saying, I'm not going to ever invest again. It was not want to be a part of Berkshire again. He just couldn't do it.
I love that. I'm glad you noticed it too. Well, I'm going to thank John Rotonti again for connecting us. John, thank you so much. It was such a joy to speak with you last month or the month before and today, and I'm so grateful you shared how you think about this very unique part of the universe that I think a lot of people haven't thought about a lot. And you added quite a bit of vocabulary to my vocabulary through this process too. And I hope this audience is more aware that the public markets have layers to it and little segments. And just to have an idea how the whole thing works, I think it's cool and beautiful to watch. Thank you so much for today. I really appreciate it. But
yeah, I really appreciate it, both of you. That was a ton of fun. Thanks so much.
Thank you.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.